There's a number that doesn't show up in your morning headlines. It doesn't trend on financial Twitter, and it definitely doesn't make it into the quarterly earnings call highlight reel that CNBC replays on loop. The number is $10 trillion. That's how much corporate America has spent buying back its own stock over the last decade. And if your first reaction is, okay, so companies bought their own shares, who cares? That's exactly the reaction they were counting on, because the buyback isn't the story. The buyback is the cover story. The real story is what's sitting underneath it, because over the same decade that corporate America was spending $10 trillion repurchasing its own shares, it was simultaneously running up the largest corporate debt load in modern history. And those two things aren't a coincidence. They're the same transaction, just dressed differently. And now that interest rates have stayed higher for longer than anyone on Wall Street was willing to admit was possible, the bill is starting to come due. Not all at once, not in a way that makes headlines, but quietly, underneath the surface, in a way that tends to only become visible right before it becomes a crisis. And that's what makes this worth paying attention to right now. But to understand how we got here, we need to back up about 15 years, because this story doesn't start with greed, even though greed absolutely shows up later. It starts with a policy decision made inside a building in Washington, D.C. that nobody voted on. In the aftermath of the 2008 financial crisis, the Federal Reserve did something it had never done at this scale before. It cut interest rates to zero and kept them there for 7 years. And when zero wasn't enough, it started buying bonds directly, injecting trillions of dollars into the financial system through a program called quantitative easing. The official rationale was simple. Cheap money would encourage borrowing. Borrowing would encourage investment. Investment would create jobs. Jobs would grow the economy. That was the theory. But there was a gap between the theory and what actually happened, because when you drop the cost of borrowing to effectively nothing and keep it there for nearly a decade, you don't just encourage productive investment, you change the entire incentive structure of corporate America. Here's why. A company's CEO has two broad choices for what to do with cash. Option 1 is invest it, build a new factory, hire engineers, develop a new product, take a long-term bet that creates something real. Option 2 is return it to shareholders, pay a dividend or buy back stock. Under normal rate conditions, option 1 often wins. The returns on real investment tend to beat the alternatives. But when borrowing costs drop to near zero, something shifts, because now the CEO doesn't even need cash to do the buyback. They can just issue debt at essentially no cost, take that borrowed money, and use it to buy back shares. And when you buy back shares, the earnings per share number goes up automatically, even if the underlying business didn't grow at all. Fewer shares outstanding means the same earnings get divided across a smaller pool. EPS rises. The stock price follows. The CEO's compensation, which is almost always tied to the stock price, goes up. The board is happy, shareholders are happy, the quarterly report looks clean, and the debt that funded the entire operation, that sits quietly on the balance sheet, earning no headlines, triggering no alarms, at least not yet. This is the machine, and for about a decade, the machine worked perfectly. Between 2010 and 2021, S&P 500 companies spent more than $10 trillion on stock buybacks. Apple alone bought back over $600 billion of its own shares. Microsoft, Google, JP Morgan. The list reads like a who's who of corporate America's most celebrated names. And over the same period, corporate debt outstanding roughly doubled, climbing from around $6 trillion to over $12 trillion. That's not correlation. That's the same transaction. Borrow cheap, buy back shares. Look like a genius. And to be clear, not everyone who ran this playbook was being reckless. When rates are near zero, leveraging a stable balance sheet to return capital to shareholders isn't automatically irresponsible. The math can work. The problem isn't the strategy itself. The problem is the assumption baked into it. The assumption was that rates would stay low. And for a long time, that assumption felt so safe that it stopped feeling like an assumption at all. It started feeling like a permanent feature of the financial landscape, like gravity, something you didn't need to account for because it was always just going to be there.